Hello, everyone, and welcome back to TradeFinder Live. It's great to be back with you all during this trading day and trading hours. I'll be introducing Mr. Rob Roy here in just a few moments, but first and foremost, we do have to cover our disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. That's the main point to take away. Got lots going on today. We got the eyes on the election, of course, Alphabet earnings after close, and oh yeah, the JOLTS report was weak this morning. So what does that mean for the markets? Lots of interesting topics to discuss here today. So I'm very excited to get that going with Mr. Rob Roy, and of course, very excited to interact with you all. So without further ado, the man of the hour, Mr. Rob Roy.
Hey, Zach. Hey, everyone. Welcome to this week's TradeFinder Live. And yeah, holy cow, lots to talk about, Zach. We did have the JOLTS report this morning. It was a little bit weaker. Bond market didn't quite know what to make about that. Yields went down, then they came back up. So we'll take a look at where they are live here in just a moment. And then, of course, the election. I don't think that's a surprise to anybody. And earnings. We're right in the middle of earnings season. We have lots of tech earnings coming out, headed by Alphabet after the close today. So I think we can see a little volatility moving in over the next week, week away from the election. If we take a look at the chart of the S&P right now, you can see that it's been kind of quiet for the last week or so. We keep bumping our head against the top of this Wave 5 tap box on the market. And notice that something interesting has occurred. We've relabeled on the Elliot Wave pattern, which I find quite interesting. So now the Wave 5 has moved back over here. Now, a lot of people poo-poo or hate on Elliot Wave, if you will, because of the fact that it relabels a lot. I've always taken the opposite tact of that. I've always felt like that's one of the best things about Elliot Wave, because the markets are dynamic. They're not static. They're ever moving, ever changing. And if you don't have indicators that are quick to move with the market, you can get caught on the wrong side of a trade for a while before your indicators turn and move back with the market. So you want an indicator that's very responsive. So the fact that we've moved here and the Wave 5 is back over here means that a lot more emphasis on this potentially being a corrective ending diagonal, if it didn't already mean that already. So we take a look here as there's the tap box that we had. So I like the fact that the algorithm keeps that here. So you can see that's one of the cool features of the software as well. Anytime you draw a line on a chart when you're looking at it, you come back to it. Maybe you don't look at it for a week or so. You come back and it remembers what you looked at before. So it gives you an idea of whatever you're thinking at the time, how did that play out moving into the future? And if you haven't, by chance, gone and gotten a copy of this software, go to hub.com, HUBB.com, get the software. It's free. You get live Elliott Wave, so you can look at Elliott Wave intraday. You can look at any other charts that you want to live intraday as well. It's a fantastic piece of software. There is a premium service available if you want AI signals, but at least go get the free Elliott Wave and follow along with what we're talking about in the U.S. market updates and here at TradeFinder. And as a quick reminder, we are doing, I'll talk about this more when we get to gold, but we talked about this in the U.S. market update. What I wanted to bring it up here in the not too distant future, I'm going to be doing a podcast with a group that is a big believer in putting physical gold into your IRA, 401k, etc. And if you're interested in learning how to do that, you'll want to be involved in that podcast. So by being here, you'll get an invitation to it. I invite you to join us. They're a great group. They're huge leaders in their industry, and I think you'll find it extremely informative. If you've heard me talk about the Fed interest rates, and man, have they been in the forefront over the last, well, ever since COVID, really, and what's going on with the U.S. dollar, et cetera. I think gold is a great diversification play for any retirement plan. So make sure you join us for that as well. So all kinds of things to talk about. But let's get to the chart of the S&P. You can see that we are at the top of that tap box. We're trying to break above it. Been talking about this potential ending diagonal here for quite some time. You can see the lines moving up. Basically, a diagonal is a bunch of 5-wave patterns with 3-wave zigzag patterns in between. So the 5-wave segments break down into 3 waves each. That's the definition of a diagonal. An ending diagonal is most often characterized by a blast off here at the very end, which would mean that we would break out of here. We've got this last zigzag that I've drawn here. So if we were to break higher and hit this 100% extension on this C wave, that would be just the absolute perfect example of an ending diagonal. What does that mean? Normally that means that a correction follows. That's why it's known as an ending diagonal. So does this happen before? I thought this might happen before the election, and then the election became a sell the news event. Maybe it's getting the election past us that generates this big move to the upside, and then the correction comes. Either one of them, it's only a few days difference. Whichever one of those two scenarios plays out, if it does indeed play out, I just think that we want to watch this. And if we do happen to hit this C wave extension, get a bit cautious on what could happen after that. So what normally happens, and the market always does the opposite of what the majority thinks, right? That's how the market works. When everybody views the market one way, the market goes the other way. If you're wondering why that is, it's because it's the path of least resistance. When everybody's on one side, much easier to make money moving in the market on the opposite direction. So the prevailing wisdom is that when you have an election, you get past the election, that uncertainty of the election goes away. And boy, do we have a lot of uncertainty going to this one, both from who's going to be president to who's going to control Congress. So you would think, okay, we get the election over, now we can relax, the market can adjust according to who wins, and then we move forward from there, and that would be a bullish thing. Well, perhaps it's the opposite this time. We'll see. But it's certainly close enough that it bears watching. And that area of that last C wave extension, which could really be that last pop higher from an ending diagonal, would be right in this 590 to 600 range on the S&P. If we're going to get that high, it does seem like maybe we would go up to 600. We've talked oftentimes about how those big round numbers act as magnets and just tend to draw whatever the security is to them, and that's no different on the S&P either. So the SPY could just run straight up to that 600 level, and then we'll see from there. So lots going on. Let me add the moving averages on. We like to look at the 10-day moving average, which is the lime green line on your chart, and we're trading right through it over the past week, trying to break above it. Let's see if we can close higher today, and first step would be to close above this top part of the tap box from that previous wave 5, and then we would look for the completion of the zigzag. So not much else to talk about as far as the S&P. We can overlay volume on here, another cool feature of the software, and you can see that yesterday was an up day, but lower volume than we had on Friday, where we did trade higher, hit the top of the tap box, and came back down and closed lower, and so we had a little bit taller volume bar there. The red indicating that it was a down day, the green indicating up days, obviously. So that's really what's going on as far as the S&P. Now, I mentioned rates with that JOLTS report, and so let's go look at the TLT. I think it's a good min range. You guys like it, and so we'll look there, take the volume off so we can see the chart a little bit better, and you can see what I mean as far as what's going on here with rates. Notice prices went down. And that means that rates were going up. Now prices are coming back up, which means rates are going back down. They can't figure out what they want to do, but they're trying on pricing on the 20-year to continue to break lower. And if we do continue to break lower, that means rates continue their move to the upside. So a little bit of a move down in rates, back to the upside in rates. So prices are a little bit higher at this moment, which means rates are a little bit higher. Why? That's the big question. And we did have Larry Fink of BlackRock come out and say that he thinks the market's going to be disappointed in the amount of rate cuts that the Fed gives us. He does see one more 25 basis point rate cut by the end of the year, and then that's it. So he's thinking 25 basis points probably at the December meeting, and that maybe that's about it. Inflation is staying stubborn in some areas of the market, but the one that the Fed has been so concerned about has been employment. And with the JOLTS report showing a bit of weakness, then maybe we have some softening a little bit in the jobs market, which would be helpful. But the bond market is not buying it yet, and so that's really concerning here as we see what's going on. So we'll figure out where things go after the election, but stuff to watch moving into the election. If we move to the dollar, and that's what I was just talking about as far as that event on gold, the dollar has had a nice run. There's a bid under it. Why? Because rates have been going up. Prices go down, rates go up. But why is the question, and that's where I think that Larry Fink may be onto something. He's concerned about where inflation is sticky in some places, and if that continues, then that could be make it difficult for the Fed to cut rates as fast as they may want to. And then we get that word you've heard me talking about over the last several weeks that nobody wants to hear: stagflation, which is when the economy weakens but inflation stays stubbornly strong. So that's the worst of all worlds. I've always said the market can handle an inflationary environment. The market can handle a deflationary environment. The most difficult market is when you have stagflation, a weakening economy with stubborn inflation. So that's the hardest one to get out of, and it's difficult for the Federal Reserve. And normally, to get out of that, you have to feel some pain in the equities market as the Fed raises rates. Now, we've been talking about the Fed moving into a rate cutting cycle. So that's moving back the other way, which is not what the equities market wants to hear. And that certainly could play into a correction type of a move if we're setting up. So you can see these things, green shoots, they call them. Normally, the term green shoots is utilized in a terminology for a bullish scenario where things are setting up to be good. But I think in this case, I'm using that analogy to say that this potential setup of a correction is showing a little bit of growth here. So that's what I mean by that, is the fact that there's some growing concern or optimism, depending on which side of the market you're on. I know some of you are wanting the market to go down. You make the comments on the U.S. market update. I appreciate all the comments that you all make and the views. We appreciate it very much. Hope you'll share that with others that you think might find the market update interesting each and every week. We've been, I think, pretty spot on as far as what the market's going to do over the last, not just months, but years, honestly, if you go back and look at the previous recordings. So still concerned about why the dollar is staying so strong if we're moving into an area where the Fed is going to cut rates. It's counterintuitive. It doesn't make sense. Let's take a look at the VIX and what's going on here with the VIX at this point in time. And we'll be able to see that kind of hanging around that 20 level there, the upper end of the new range that we've been in. We talked about this in ad nauseum, how the VIX was between 12.5 and 17.5 for quite some time going into the middle of the summer. Then we had Yen Monday. You know the drill. You've heard me say it a million times. And then the new range has been between 15 and 20. And we're just kind of hovering above the 50-day moving average on the VIX at the upper end, around 20. It looked like maybe in early October we were going to break a bit higher in the VIX, but we came back down, got within that range, but we keep bumping our head against that. And I do think that plays into added volatility over not just the next week into the election, but potentially the next few weeks after the election. Could see some advanced volatility as well. Here at Evo Trader, that's what you love. So evotrader.com is focused on options. And if you're an options trader, I think that it's universal that option traders, if you had to ask them, what's the one word you want volatility is going to be the key. And the reason for that is options, when you buy options, are time decay sensitive. So you want stuff to move faster. The slower it moves, the more time decay affects you. But when you get things moving quicker, it's easier. And that's what we look for. I'm trying to generate gains in a shorter amount of time. Let's take a look at where we are with some of the other markets. The Dow, which had been doing so really well, coming out of that consolidation at 420 there into early October. We took off. We got to above 430, hit that wave 5 high, come back down. While we're trading through the 10-day moving average on the SPY, we're now trading under the 10-day moving average over the last week on the DIA. Not a huge difference, but a slight difference. And curious as to why money was moving into the Dow and hasn't been. Maybe all the rotation that institutions wanted to make into the Dow has been complete, and so they're not looking to do it anymore. Their positions are there. They're positioned and ready, if you will, for the election and what's to come between the election and the end of the year. But interesting that the Dow is now slightly underperforming the S&P when it was doing the opposite not that long ago. The Qs just continues to confound me. I don't know how else to put it. You've heard me talk about this as well. Up today again on the Qs, even with the way rates are acting, which doesn't make any sense at all to me. Maybe we get this completion of this zigzag. I've been saying for a while that it would surprise me if we completed this zigzag, but maybe we do. The market surprises me all the time. Just counterintuitive to what's going on with the strength of the dollar, rates, etc. But it's holding above the 10-day moving average and looking like it wants to go up and hit that level. It's right at 510 on the Qs is where that C wave extension would complete. We had these nice triangle patterns here where we broke out of this triangle, came back down, tested the point of the breakout, formed another triangle. Looked like maybe we're going to break to the downside. Nope, that was a head fake, at least for now. False breakout, and we look to be heading higher. Would not surprise me now to see that C wave extension completed, not with what the pattern looks like at this point. Just before, I would have been really surprised. And the algorithm still has this wave 3 in green, which means the algorithm feels like the wave 3 is still underway. That would also lend to a little bit more movement to the upside and hitting that 100% extension on the C wave. We go back and just as a reminder on the B wave correction, right near that 61.8% level, which is my favorite of all fib levels in the zigzag. I just feel like it gives you a higher percentage chance that that zigzag is going to complete. And with a 61.8% B wave correction, that yields to that 100% extension. So it's classic Elliot Wave that's going on. And this is a lesson that I learned a long time ago when I first started trading. In my early days of trading, the more I learned, the more I thought I knew where the market was going to go. Because you gain this knowledge, you gain education, you learn more about economics, etc. I took economics in college, but you put it into practical application, trade against it, and it becomes a little bit different than what you learn in books. And so you get some actual real world experience when you're trading and learn that the market's going to do what the market's going to do. And it doesn't always do what makes sense to you or what you feel like the market should be doing based on even a tremendous amount of education earned in the market. So you trade what the market gives you. You trade the charts, and you have to take what you think is going to happen and what may make sense to you with economic data, et cetera, out of the picture. That's how you become successful. Trade what the market tells you, not what you think is going to happen. So still real interesting on the Qs. And then we move into the IWM, kind of consolidating here a little bit. You know the drill here too. So not a whole lot is different as the market just waits for the election and to see what happens there. We do have this building ascending triangle, which is really getting well set up. Unlike what oil did, which we'll look at oil, it was setting up in a pattern like this and then broke out to the downside yesterday. So we'll update that here in a moment. But moving back up as we move up towards the upper end of this range, or even doesn't have to get quite back to 225, the upper end of the 20-point range between 205 and 225. But we're starting to get into the point of this triangle. And if you look at this and say, well, there's still more sideways to go here, I've been talking about this lately as well, just as a reminder that I've done an awful lot of work over the years on triangles. It's one of my favorite patterns to trade, and learning that we don't always get right to the point of the triangle before a breakout. I made that mistake where I would want it to be right in. I mean, I'd want it to get right to the point, and I'd be watching a pattern. And you see this pattern developing over months, and you're right here and you're watching, and you say, just a little bit more, just a few more days in this area, and it'd be perfect right into the point of the triangle. Well, patterns don't always get perfect. We're getting close enough, is what I'm trying to say, that a breakout of the IWM at any time now, I think, is likely. Perhaps we go sideways for another week or two. Maybe we don't. Maybe we break out in the next few days, even before the election. Or maybe it does take the election to ignite the breakout. But that's something clearly to watch. There's going to be a pretty significant move here coming in the IWM. Which way is it going to be? We don't know, even though we have a wave 4 here labeled right around the 38.2% fib level correction. That would yield a 61.8% extension in the wave 5. But even Elliot himself said that a triangle trumps everything. So regardless of how good the Elliot Wave pattern looks, when you have a triangle, you just respect the fact that it could break either direction, and you don't get caught picking a direction on a triangle. And an ascending triangle coinciding with this wave 4 labeled and potential wave 5 move higher. You can see that the algorithm has it over around 235. Notice into January it takes to get there. So, but when you see this triangle and such a well-formed triangle, don't get caught with an ascending triangle and a wave 5 pattern saying, no, we're breaking to the upside on the IWM, and you go hard long. You have to respect the fact that it could go either direction. So these are the things that I like to share with you in these events, the stuff that I've learned over the years, and sometimes it's counterintuitive to a lot of other information that you get out there that's just flat out false. And an ascending triangle does not mean you're going to break to the upside. We could break to the upside, but we could break to the downside just as easily. You can break either direction out of any of the triangles. All right, let's look at the metals. So we take a look at GLD. We had that as one of our case study considerations, as you know, and talking about those, gosh, the only one we have left is our protective SPY position. That was an actual idea within the software. Another cool thing about the software, if you haven't seen it already, Zach's going to come back at the end and show you how you can post your own ideas or vote on other people's ideas. So every time we do a case study consideration here at TradeFinder, we post it. The last two have just been posts, just thoughts, basically, not actual actionable ideas. So Zach will do a good job explaining the difference between those two at the end, but you can see we're getting a little bit of a pop back in gold again today, which also is with interest rates higher. Why is gold moving up? Then you can make the argument, well, the Fed's moving into an easing policy. That's why gold's moving up. Perhaps because that is a correlation that exists in the market. Or are we moving up in the metals because there's concern about where things are going to go economically, et cetera, and that we're going to get some sort of a significant move down, and gold is acting as a defensive sector. It's a play of protection against something else happening. Another reason why you want to attend that event on putting gold into your retirement plan. So that's where we are on GLD. So we'll see how SLV, silver, is hanging in there. We had talked about could silver play catch up, which it did. It had been lagging behind GLD and had this big vertical move. We got a little too far away from the 10-day moving average. You know the drill. No security in any time frame gets too far from the 10-day moving average. So we came back down got right around the 10-day moving average, and now we've been kind of trending back up, and we're up today on SLV as well. And notice again, the algorithm still has that wave 3 active also. The algorithm doesn't think SLV is done going to the upside just yet. And if we can take out this wave 3 high, notice we're right back to the 100% extension. And I just want to highlight on these zigzags, when you have a 50% B wave correction and works exactly as a 61.8% fib level B wave correction, meaning that you look for 100% extension. So that's what was supposed to happen out of the zigzag, and it's done that. So once you get to your C wave target on a zigzag pattern, what you want to look for is what is the likelihood that you move to the extended C wave target, the next level, in this case 161.8. So I like to look at the DMI as an indicator to tell you what's the strength of that C wave move. Obviously, the stronger the C wave is, the more likely it could be to move to that extended C wave target. And if it's a weak move, then maybe that target is the end. So if the DMI was showing us that this was a weak move here, you would think that could be the end of it. And maybe we start to retrace. And when a zigzag pattern ends, what normally happens is the C wave gets retraced. In other words, we move back towards where that B wave correction was. But when we come down here and look at the DMI, that's setting up to tell you that, hey, this move is pretty strong in SLV. It looks like it's going to go higher. Not only do we have the ADX moving up now and starting to break above 20, which is really important to get that ADX above 20. It's above the negative directional indicator. The two directional indicators are separating. The negative is going down. The positive is going up. If you wanted to say or give an example of what does a confirming DMI look like, that's what it looks like. So in this case, the DMI is telling us, hey, yeah, we do have a pretty good likelihood that we are going to have an extended C wave. So I think silver moves even higher. We had it going to 31 in the past as a case study consideration here. We got there. We came back down to the 10-day moving average, but now it looks like maybe it's time to reload on SLV and move back higher again. So that's going to be pretty compelling and pretty difficult to beat as far as when we start looking for our case study consideration for today. Let's take a look at the crypto world. Perhaps you noticed that Bitcoin did break above 70,000 last night, and that has continued into today. Look at this move in Bitcoin as we are continuing to break out. And then there's two zigzag patterns. I clicked on the C there instead of the arrow, but the 100% level there is up above 75,000 on Bitcoin. And it certainly looks like that's what wants to happen here on the BTC Bitcoin, that we could continue to move here and go up to that level, up towards that 100% extension. But really coming out of Bitcoin today of 72,000, we're almost 73,000. So I'm telling you exactly where Bitcoin is right now. So clear break of that A wave impulse, the B wave right around 38.2. Same rules apply here. With 38.2% B wave correction, you look for a 61.8% extension. We've blown through that already today, which means once you break above that, you look for the next level, which is 100%. And then this larger zigzag that started back here in September gives you a 100% extension. And then the complex C wave gives you a level up here. So we're touching the first zigzag at 73,000. And then we have two more that are telling us that we could go a little bit higher. So all things looking bullish on Bitcoin at this point in time. And then here's the DMI also looking just like the classic example of what you would want the DMI to look like if you were expecting something to continue higher. So what's that telling us? We know that between the two parties, one party is far more favorable towards Bitcoin than the other party. So is Bitcoin trying to forecast the election results? Maybe. We'll see. We only got a week to go. So in another week, we can stop talking about what could happen in the election and actually start talking about what happened in the election. So if we look at Ethereum, ETH, nice break there today, forming an ascending triangle here in Ethereum. And so a little more back in filling, perhaps coming up and testing this 2750 level would be great. So we're getting a pretty solid look here on the formation of this ascending triangle within Ethereum as well. If Bitcoin breaks higher, then you could certainly make the argument that it's highly likely Ethereum breaks higher as well. And since Bitcoin is already breaking higher, maybe Ethereum breaks to the upside. But again, just because it's an ascending triangle doesn't mean it's going to break higher. We're looking at other things for that possibility. And then Solana, everybody's been asking about that. I know that's real popular with a lot of folks right now, breaking higher as well, up to 180 on Solana, so making a nice move here. And then looking at the DMI, also very constructive. So everything looks strong and bullish at this point in time, and that's all we can do when we're looking at charts is analyze the data that we have at the moment that we're analyzing it. And as I said before, you want an indicator that if the market changes quickly, your indicator changes quickly. But right now, the algorithm is saying that that's in a wave 3 also. In other words, that it's likely that Solana continues to the upside from here. So things looking pretty good, as I said, in both the metals and in the cryptos, which is pretty interesting considering what's going on with the bond market. So there's some, I call discombobulation. There's a few things that normally work in correlation. There's an old expression, correlations work till they don't. But there's some age-old correlations that once they get broken, it's for a shortened period of time. And then eventually the normal correlations between the bond market and the equities market, et cetera, come back into line. Right now, they're in that discombobulation phase, but at some point, things will make sense. Right now, they don't. But that will come back into play in the not too distant future. So let's look at natural gas. I think we might have something going here the opposite direction. Now, we did this one as a post a couple weeks ago. This was not an idea, and that was because we weren't sure what was going to occur. Now, look what's happened here. Also, a relabeling on UNG. So before we had this wave 5 target down here around 10, that if we broke below 12 and a half, we could move down here. And this is why I've been stressing you don't jump the gun yet. We bounced off 12 and a half. We bumped our head on the 50-day moving average. We came back down towards 12 and a half. And gosh, yesterday with the move down, it certainly looked like, hey, time to go bearish on UNG. And now the algorithm has relabeled again. So now it's like, oh, this is why we wait. Because now maybe that's changing. Maybe 12 and a half is going to hold after all in natural gas. So I don't like the DMI as much on bearish moves as I do on bullish moves. So we'll take that off and we're just going to have to watch now. So what looked like it was setting up as a really good bearish trade, maybe we're back to what we talked about a couple of weeks ago, where we thought we were going to get a bounce off that 12 and a half level, and maybe UNG could go higher, perhaps up to 16. That, which has not looked good since it was labeled as a post, could actually play out and be accurate after all. So that'd be interesting to see. And then USO, you'll see what I was talking about here, how we broke to the downside. And this is what I meant about when you're watching these triangles and you can't wait for them to get too perfect. We're forming this ascending triangle, and an ideal formation would have been a little bit more of a bounce off this lower trend line, the higher lows, and come up to 17 and a half again. That would have been ideal, but the market doesn't always give you what's ideal. So yesterday we broke to the downside on USO. What does that mean? I know the whole headline was that, the Israel-Iran missile stuff didn't have as much of an effect on the oil supply as perhaps concerned about. And so since the supply wasn't interrupted, we moved back down. Or is it something a bit more nefarious, like the economy is going to weaken significantly, and that's what's driving USO down. I do think the bottom is limited here on USO if OPEC is to be believed, and that's that they do want to keep oil prices elevated. They know they've done the geological surveys. They know that their supply in the ground is dwindling. They've come out and said they want to make as much as they can while they can. And I just don't think they're going to allow oil prices to go too low before they start cutting production. Easily, we could come down here and test this trend line just above 65. But to move significantly below there, we'll have to wait and see. That's going to be a Missouri type thing. Another one of the analogies that I use, the show me state, is going to have to show me a break below 65 with follow through before I could buy into oil going lower. But if it does that, again, you follow the charts, not what you think is going to happen. So it does seem like we want to come down and test this area here, this lower trend line, a little bit oversold with that big move down in oil yesterday. But perhaps we'll find a little bit of footing here in the 65 area. But we do need to correct this slightly oversold condition first. So even a little bit of a bounce up here, even a bounce up to test that lower trend line wouldn't surprise me at all. That's right where the 10-day moving average is, as you can see, which is also right around where the 50-day moving average is. So a couple pretty primary moving averages right where that lower trend line is. So even a bounce back up to there, I don't think would be too surprising. But this is a perfect example of what I was talking about earlier, that you don't always get the ideal triangle scenario. So again, that was a lesson that I learned a while back, where you're watching these formations for months and then all of a sudden it breaks out because you waited for it to get too perfect and you missed the trade. You spend all this time waiting on a trade to set up and then you miss it because you tried to get too cute with it, I guess would be the best way to put it. So let's go ahead and look at a few of the international markets and see what's going on around the globe. And then we'll start talking about case study considerations and then get to the most enjoyable part, which is the Q&A with y'all, because you're in tune with what's going on and ask really good questions. So we see that the EWA is breaking down. This one I don't really understand either. Oftentimes the EWA Australia moves with the metals because they're resource rich there. And that tends to play into their movements. But we have gold moving up and the EWA moving down. And I've had some of our Aussie subscribers give other details of what's going on down under and giving other reasons why that market might be going a bit lower. But now at this point, it does seem like that C wave is finished. So we had roughly the 38.2% B wave correction. We didn't actually make it there. So 61.8 is all you're looking for. So that zigzag was spot on as well. And now we're forming a zigzag back to the downside. And what normally happens, just to reiterate what I said earlier, is when a C wave ends, you retrace that C wave and move back to the B wave. So we could be looking at 25 on the EWA. Let's look at Canada. So we'll look at what's going on with our friends up north. And you'll see that they have they were pretty much going back over here into September. They were in lockstep with what was going on with Australia. And now they've separated a bit, still moving lower, but not quite to the degree that the EWA is anymore. And basically, we're in a trading range here in Canada, pretty much between 41 and 42. So it's a tight range where we've been just going sideways since we broke above 41 back here in early September. So we'd want to see a breakout either above 42 to go long or below 41 to go short. If we break to the downside, so here's that 30% B wave correction, so 61.8% extension. Again, spot on. That's why I trade this stuff and have been since 2001, because it works. Nothing's 100%, but I've yet to find an indicator as accurate as Elliot Wave if you take the time to fully understand it. It's not easy. It's complex. There's a lot to it. You have to put the time in. You have to learn the rules and guidelines, etc. But if you do that and become good at it, I submit to you that it would be hard to find a better indicator out there. So probably back down to the 50-day moving average here around 41. As long as we stay above this A wave impulse, you could stay cautiously bullish if you wanted to on the EWC, but I think the more prudent thing to do in the Canadian market is just wait. Just wait for a break, either above 42 or below 41, and then you'll have time to make a directional move from there. Let's go over to Europe with EWG as our example of what's in the Eurozone. They're ahead of us on their rate cutting cycle, and we're forming, as you can see, a bit of a descending triangle here. So far, holding above that A wave impulse. We tested it here towards the end of October, broke right back above that 32.5 level, and now we're getting this pattern of lower highs here. So there's your descending triangle that's forming on the EWG, and another zigzag that completed perfectly. That one did go right to the 38.2% B wave correction. As I've mentioned, 61.8% extension. That's where we went. And then bam, just like hitting the roof here, bumping our heads against the ceiling and then back down, and we've gone sideways, and now we're consolidating here. Also, highly likely as far as what normally occurs once a pattern is completed to move into some consolidation. So a lot of things changing early this week with these Elliott Wave patterns moving into the election, which is quite interesting. And then let's look at the INDA. It's trying to hold that 55 level. We've talked about it. We got this one really spot on as well, where we said when we were trying to hold here at 57, if we couldn't hold it, we'd probably make a move down to 55 rather quickly, which we did. We got a little bit oversold. So now we're consolidating a bit here around 55, and that 10-day moving average is coming down and catching up. Now the question is going to be, can we hold 55? If we do and can bounce, but we got to get back above the 10-day moving average first, so don't jump the gun there either. Let it get back above the 10-day moving average. If it does, perhaps we come up and test 57. We got to get above 57 to be really comfortably long the INDA. But if we can get above the 10-day moving average, there may be a short-term trade here on a potential further bounce to 57. But that's all it would be a short-term move. Again, to get really constructively bullish on the INDA, you got to get above 57. But right now, we're more worried about 55. Can we hold this? And if we don't, then we're probably coming down towards that 53 level on the INDA. So that's more of a concern right now than anything else, is how do we handle 55? So once again, I think the prudent thing to do on the INDA, if you're trading that or the Nifty, is to be patient. Let's wait and see if one of those two things happen, back above the 10-day moving average or below 55. And then we can start to look to see where we may go on the INDA from here. But finally, a bit of a much needed break, I think. On the INDA, you can see that wave 5 was awfully extended at 212%. You don't see many of them move that far. So that was a very extended wave 5. So a bit of a break is nothing to be concerned about. It's just normal. And it's what really needed to happen, because things can't go one direction forever. There is ebbs and flows. There's impulses and corrections. That's what makes Elliott Wave work. The market moves in impulses and corrections, and that's the exact thing that Elliott Wave is designed to identify, impulses and corrections. So that kind of gives you a bit of a rundown on what's going on with the markets, the metals, cryptos, etc. As I mentioned in our case studies, we kind of talked about a couple of them already, where the S&P, I know that one looks pretty bad, but remember, that was all designed as a hedge against a basically long portfolio. If you're following the markets, you should have been heavily long, and it never hurts, especially when you're starting to get into the nosebleed area of an upward move, to have a hedge against the portfolio, have something in case you get a big corrective move. You've all seen it, how fast the market can move to the downside when it wants to. Hasn't wanted to yet, but once it does, it can move quickly. So even though that's a loser on the website, we've had an awful lot of bullish winners and it's just a hedge. It was never designed as anything more than that. We didn't put it on thinking that the S&P was going lower. We put it on as in case that we got a break to the downside out of this diagonal a little early, and it would be protection against the longs. Now the longs are pretty much all taken off. And then last week, we looked at Boeing as a potential, and this is another one that was just a post. It wasn't an idea. It was just, thoughts of what could happen here. And when I talked about this last week, I felt that perhaps that strike was going to end with Boeing. I said their earnings report wasn't going to look good. It didn't look good, but if we could hang in there and get that strike over with, then perhaps we could get a little bit of a bounce to the upside on Boeing. Hasn't ended. I still think once that strike ends, you'll get a bounce out of Boeing, but we're having a pretty wild day today. As you can see, as I spread this chart out, you can see that we opened a lot lower, but we are trading higher here. So I would submit to you that we are having some pretty good consolidation here on Boeing. It gets into that point, and I've said this before, and they've proved me wrong on what else bad could happen to Boeing when it just seemed like week after week they had some sort of bad news coming out, and it's like, what else could there be? And now we've gotten the bad earnings report out of the way. The strike is still going on. And yet we're still kind of hanging in there. So I don't really feel any differently about that post either. So we had just within the last few days, both those posts on UNG that looked like that one was going to be wrong. And then this thought on Boeing that was going to be wrong. And it could turn out that both of them end up being right. You could certainly argue that with everything bad that's happened to Boeing, we ought to be down at that 140 level. And we're not. We're at 154 right now. And if we could somehow break back above 160, I think we could see the move up towards the 180 level rather quickly. So I don't think there's any reason to feel differently about that thought process either. All right, so just to give you a rundown, with the way the market's moving right now, with this S&P in this potential ending diagonal pattern, perhaps there's one last blow off. It doesn't have to happen because, again, that would be the ideal scenario. And as I've said, the market doesn't always give you the ideal scenario. There hasn't been a whole lot of good-looking things from a directional standpoint. We have had some movement out of some of the banking stocks. If you're looking for something positive, because I've highlighted a few things that would be worrisome in the market, but the fact that the XLF, the financials, have held in there pretty well, and there's select bank stocks that the AI has given us from this software that are doing quite well. Overall, the XLF has hung in there admirably, I would argue. And if you feel like that you need the financials, some people believe that. Not everybody does, but some people believe you need the financials to move higher in the markets. Then that's where you could come up with a constructively bullish argument that, well, why are the financials still doing well with rates being higher? Typically, when rates move lower, it's more conducive to the financials moving to the upside. And that's not what's happened. There's still the viewpoint that the Fed is going to cut rates and continue to cut rates. And perhaps that is what plays out. The inflation story is not a concern. The stagflation is not a concern. And that we do move into further easing on rates without the inflation concerns. And we get another breakup to the upside out of the XLF. You can see there's a small triangle there. It's not very big, so it's not forecasting much of a move either direction, but we're going to get some sort of a little breakout here on the XLF. I don't know if it's going to be higher or lower, but it's really not a tradable break. I like to put strangles on here. That's my claim to fame in the option world, is creating a unique setup for a strangle that takes the greatest advantage of the delta acceleration through gamma, and that's a pretty good position to put on oftentimes. But when you have a small move like this, it's not enough of a move when you have out of the money options like that to generate one making money much faster than the other is losing, which is how that strategy works. You break out, one option's making money, the other one's losing money, but the strategy works because one's making money much faster than the other one's losing money, and the net between those two is where the profit comes from. But you do need a decent sized move. You need about a 10% move out of the underlying equity to make that strategy work. That's one of the guidelines of it. And here it's only, it's a little over a point move. It's not even close to 10%. So that's why I'm saying that it's a little triangle. Something's going to happen. We're going to get about a 1 point move, breakout on the XLF from this triangle. It's not enough to generate a profitable strangle on. So we wouldn't want to do that. But I just wanted to share that because if you are looking for where are the silver linings and everything that's going on, that would be your argument. Why are financials hanging in there if everything is getting ready to correct and move to the downside? And it also takes some of that inflationary argument out as well. So that's where you're focused if you're bullish and you're wanting to have a bullish argument on where things could go. But from all the charts that I've looked at, without too much giving us good setups on a directional standpoint, the best chart I can come up with is that SLV chart. And that is going to be our case study consideration for today. And Zach, we will make that one an idea. So we'll go back to an idea instead of the posts with everything that I've shown. Awfully solid DMI. We have the wave 3 moving to the upside here. We have a perfect B wave correction. It does seem like we're going to get that extended C wave there. So we'll look for that to move up towards 33 on the SLV. That'll be it. And Zach will come back here in just a few minutes and show you how to post that. But I've been rambling on. Let's get to a couple questions real quick, Zach, before you show the folks how to do that.
No worries. It sounds like a plan. Excuse me. Thank you for another insightful presentation. We'll start out with J Blue for Trade Simple. JBLU.
Yeah, good old JetBlue. And, in the news, there's going to be a merger. It's not going to be a merger. And it's just been rough on this stock. Delta had a decent move because they're doing some cost cutting, et cetera. They're doing some things to improve their bottom line. And then you see this drop down. I don't know if that was an earnings report on JetBlue or not, but you can see the wave 4 is interesting right here at the 61.8% level. So we have this gap down and down here at $6. So it's a low dollar stock. But if it's going to hold here, and it's not a poorly set up 5-wave pattern, if it's going to hold, this is where it's going to hold. So if you have like speculative money laying around that you're looking for, just take a shot at something type of ideas, I think you could do worse than trying to take a bit of a bounce off this wave 4 level on JetBlue. If it doesn't hold, the next support is at 5. So if you break below 6, then you're going to break this wave 4 here at 61.8, and I think we probably do see 5. But if you wanted to take a flyer here, get that? You see what I did there, Zach? Take a flyer on JetBlue.
It's a good
zinger. Then you could take a shot at this one on a bit of a bounce back to the 10-day moving average, maybe even fill in the gap, but it doesn't even have to go quite that far. But once again, if it breaks below 6, I think that's your stop and you're out. But just because of where that fib level is, could possibly hold, I think you could take a shot at that one. Gosh, we haven't looked at JetBlue in a while. So,
indeed. Let's check out Ulta, ULTA.
And we'll see what's going on in the beauty supply world. And pretty nice formation of a triangle here. So something's getting ready to happen on Ulta. You can see the wave 5 completed back here in August, and we've just been going through. This is called a flat, where you have a big sideways correction, and now the flat is ending. in this triangle formation. So this is really good Elliot Wave information here. So we've got an ascending triangle. You can see the highs that have formed and just created a resistance area right there around where we are at the moment. And then as we came out of that wave 5, we went into this flat pattern here where we just pretty much consolidated after that move. And that's what you expect. There's a corrective pattern that normally occurs when a wave 5 ends, and one of the corrective patterns is a flat. There's flat, zigzags, and triangles. One of those usually plays out following a completion of a 5-wave pattern. So there's the flat that is now, I call it morphed or moved into a bit of an ascending triangle. Once again, it's not large enough to trade, I don't think. It's too expensive of a stock for a triangle the way we do them at EWO Trader, because we don't do anything more than $500 at risk in any one position. So you're not going to get a triangle the way we set them up at $500 or less on a $375 stock. And then in addition to that, it's only a even rounded up to a 30-point move. And at 377, it's still under 10%. So it's not enough of a movement to put a trade on, even if it met the guidelines for risk management. But something's going to happen here. I think I'd keep an eye on it, see which way it breaks, and then you got the rest of the move. So it should be close to a 30-point move from where it is right now. So it could come back up to 400, or it could go back down towards 340 on the breakout. But something's getting ready to happen there on that stock.
Very well. Thanks, Rob. See, we're at 3 minutes till the hour, so let's do one more symbol, and then I'll show everyone how to post on the platform.
Sounds great.
All right. There's been a lot of chatter around this one. OKLO.
OKLO. All right. Let's familiar with OKLA. So this is one not as familiar with, but nice little zigzag there in the wave 3. I love that from a directional standpoint. So whoever asked that, I hope perhaps you've been watching and you're a zigzag fan because you found a good one there. So we're right at the 38.2% B wave correction level right here. That only brings us to 61.8 though. And we're not too far away from it. So the problem is it does seem like it wants to go a little higher from here, but there isn't much room until we hit that fib level, which would be the initial target. So just above 25 here, right around, let me get the crosshairs out here and we can see exactly where that is. 26 and a half is about where you think that one would go. So you look for 27 and a half, and then we'll have to wait and see what the DMI looks like at that point in time, if it looks like we're going to have an extended C wave or not. So I think you have a little more move to the upside here, but not a whole lot. So I don't know if that's enough for you to trade or not, but it does seem like perhaps there's a little bit more to go higher here. So
Wow, shout out to Jay Bishman from the chat on that one, who's in at 880. So definitely a good call on that.
Oh yeah, well, congratulations! Right. Yeah, congratulations. So there's hitting the exact bottoms and exact tops is quite difficult. As much as I love zigzags, you are in that low, then you've got a super nice gain here, and at least tighten your stops, if nothing else, because it does seem like it's heading towards some resistance here. But congrats on a great trade.
Yes, exactly. I echo those sentiments. All right, so let's go ahead and take this time to move over to the platform, and I'll show everyone how to post our case study consideration or trade idea for this week. As we'll see here, this is a menu view, a jumping off point of everything that this platform has to offer. You can see some of the trending members, ideas, and themes. As Rob mentioned, you actually have the opportunity to vote and interact with other community members of this hub platform. So we'll click on here. This one is actually from the account manager, Stephen Camp, and you have the option to agree, disagree. You can change your vote at any time up until that trade is closed. You can comment on the overall analysis that's provided or the context provided by the person that posted the idea. So we encourage that, even if you disagree. As Rob will always say, opposing opinions is what make markets, right? If everyone agreed on the same things, there would be no trades, as there has to be a buyer and seller for a trade to even be possible. So for us to post an idea, we're going to go up here over to new idea. Rob mentioned briefly the difference between an idea and a post. The past couple of weeks, we've had a post. Essentially, that's going to be a draft idea, meaning that the criteria for the full idea is not fully met, as if you were actually going to trade this, whatever position you are selecting, or whatever symbol you're selecting, rather. It would be, you could equate an idea to paper trading. All of this real-time data and everything that would be available if it were a real trade with real risk on the line is going to be available for an idea, whereas a post would be essentially what Rob mentioned a bit earlier, as you see a lot of potential in a certain symbol, but you need some fulfillment in whether a fall through day or whatever your criteria may be for that symbol. So for this one, this is going to be an official idea on SLV. That would be SLV. And we'll find the symbol in the search here. The target price on that one, Rob?
33.
33. And our time frame?
Let's go ahead and go out there and do the 3 months.
Very well. So as you can see, we have these fixed intervals of time for you to select here. However, if you needed something more specific, you can go down to custom and pick the very exact day that you would like it to expire at. So we're going to go with the 3 months here. This will be made very shortly after this session. But as you can see, I'm going to confirm and post this idea right now. So as we just mentioned, we encourage you to come in and vote whether you agree or disagree. Get the confirmation message there that the idea is now published. So it is available for you all to go in and interact. And we encourage you to do so. So I think that about covers everything for this session. I see we're a couple minutes after the hour, so I don't want to keep anyone from the markets. And I'll pass back over to you, Rob.
Thanks, Zach. Great job as always. And I thought this was a pretty good session, so hope everybody felt so as well. Awful lot to keep an eye on. I watched the earnings after the bell and over the next couple of days, and then, of course, the election next week. So, it'll be a wild Tuesday when we talk again next week. We'll probably have some sort of really early election results coming in, I would think, by the time we start talking. So we'll see how the market's reacting to that. I look forward to that. Another great thing about having these sessions live. Thanks, as always, for taking part of your trading day to hang out with us. I hope you found it informative and look forward to talking again soon. Take care, everybody.